All right, good morning, everybody. It is 6:29 and 3/4 a.m. on Wall Street. The sun is just rising in this part of the universe. So welcome to QuantBox Live. Hang on, I guess I should log into QuantBox. All right, here we go. Welcome to QuantBox Live. Today, we're going to uncover the best fundamental investment opportunities across the global markets. My name is Wayne McDonald. Not only am I the founder of QuantBox.co, but I'm a Harvard-educated macroeconomic economist, which means I love all things macro, and that makes me a trend trader as well. If you're watching this on YouTube, guess what? It's probably 10:30, 11 in the morning for you, and you're like, wow, this is super interesting. Well, if you were a subscriber to QuantBox, you'd be doing this at 6:30 in the morning. So anyways, why don't you give a try? It's less than $8 for a week. And with that being said, let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term. Never risk money you cannot afford to lose. All right, let's get on with it. Let me log into the Google Cloud. Let me get my sip of cafe. Logging into the Google Cloud. Pop, 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 pop. All right, so the first thing I go to is the scatter plot. And this is awfully pretty. There's a lot going on here. NASDAQ way down. We'll have to take a look at that. Bitcoin having a tough day. Looks like US dollar's weak. So this is very similar to the New York close yesterday. So now it's been what I don't know, a little more than 12 hours, and everything's about the same. So not a lot changed in Europe and in Asia, but nonetheless, let's take a deeper dive. How about this? Isn't that pretty? So this is a new tool that I'm testing. I just popped it out there yesterday. No fanfare. We didn't do a parade or anything, but it is kind of cool. So now when you go full screen, so I've designed the tool to be perfect in full screen mode. Okay, this is when it's just regular and you're like, man, there's a lot of white space. Yeah, well, if you go full screen, okay, it's perfect. Okay, great. So we got that going on, but also you can just add and subtract things really quickly now. So I remove commodities, remove crypto, remove the stock markets. There's all the currency pairs. And let's say I just want major currency pairs. Boom, there we go. See how easy that was? Isn't that sweet? Now check that out so we can see very quickly dollars weak, dollars weak, dollars weak, dollars weak. Yeah, but dollars weak, and dollars weak. So if you're a bull in the US dollar, wah, wah, wah. Okay, bad day today. That's all right, because what you want to look for is if you're a dollar bull and today is dollar weakness, then you just got to wait. You might have a setup developing, but you might be early. Okay. So again, just a quick one. If things are over in this quadrant, so let's do it this way. If things are in this quadrant, okay, this is a positive quadrant, but if you see an asset in here, quantitatively, it had a negative score. The same thing down here, okay, where this is a negative quadrant, but it's got a positive score. And those are things you don't want, okay? Because what you want is a positive, positive, negative, negative. And you're like, what do you mean positive score? So again, remember, QuantBox is quantitatively pulling in the macroeconomic data and then scoring it, ranking it, and then doing comparative analysis. And from all of that, it gives it a good, a positive score or a negative score. All these assets actually had a negative score. Okay, but they're up today, which means maybe they're down tomorrow. So pound dollar, for example, has a QuantBox score of -7, but it's up today. Yeah, up 0.17%. So slightly up. So it might be set up now for a sell. It's up, but you think, or QuantBox says maybe look for selling. Now you can see this is up much higher, 0.5%. But that's how this works, right? You can see how high it is shows you the the change in price, and then how left it is the score. See, -7 versus -5. Okay. So something way up here would be sort of QuantBox would expect to be very, very, very negative, but for some reason today is very, very, very up. Okay, pretty rare. Okay, but this is the biggest one, right? Euro dollar, QuantBox score of -8, but it's up 0.35. Up 0.35. Is that the end of the world if you're a bear? Up 1/3 of 1%? No, no, no. Okay. So, anyways, these might be opportunities. These might be opportunities. Okay. Throw in the stock markets around the world. If you want, I can strip this out. Okay. So 10-year T note, you can see it's got a slightly negative score and it hasn't changed at all. Perfect, right? As rain. S&P 500 has a negative score and it's slightly negative. Is it a big deal? No, it's not a big deal. NASDAQ has a slight negative score, but is down 1.29%. Okay, that's a doozy. Okay. And this is a big up and it's a pretty big down today. So this might be out of position. So, anyways, that's how you use that tool. I hope you like it. And of course, you can just look at everything. Okay. All right. So I did that for you because you're my sweet baby. I hope you like it. You can kind of get the same thing, but not scored on expectation. Just is a map of what is. Oil's up today, which is a good thing. NASDAQ is down today. Very often, what you want to find is something in the neutral zone. So you can see all the yen pairs are neutral right now. So maybe they have some opportunities. Okay. Let's start with a basic here. Let's start with euro dollar. Okay. Strong sell. But look at the seasonality. Okay. There's sort of this, I don't know what you want to call it, sort of the dipsy do coming into the summer. And we seem to be like, look at this, like way outside the norm, right? So on the 20-year average in the spring, there's usually a little bit of up. And then we had this giant up, and then it normalizes, and then there's a giant down. You're like, whoa, that's that volatility of the Fed, right? And then we kind of have this dipsy do over the summer, and you can see now the pendulum has swung way too far. So maybe we got to be careful, even though it's a strong sell, it might want to kind of come back, right, and fall later in the summer. But got to pay attention to that. That's why QuantBox uses technical analysis. And compared to other, let's say quantitative tools, throwing in technical analysis is a competitive advantage. It's not that common. Probably because the people that develop quantitative software don't think technically at all. In fact, they're probably anti-technical. They're like, technical analysis. I'd rather die. And I'm like, whatever, man. Throw it on there. So, and you can see that it actually weights it pretty high. Like I believe technical analysis is quite important. So it's weighted. It's got double the weight than other components. Okay. On euro dollar, COT is neutral. Investors are 76% of investors are long euro, 68% are long dollar. Neutral. You see? 70% of retail investors are long euro dollar. And it doesn't look like the greatest thing to be long. Now, we know it's up today, but according to this analysis, remember all we're doing is we're calculating the mean price of all these daily candles, and then you want to then calculate the slope of the mean price of all these candles, and then you want to project the slope forward into the future. So it's presuming the rate of change is in the same direction at the same rate. And then you calculate you calculate the variance, and then you square root the variance to get standard deviation, and you project that linearly, right, into the future 7 days. And that's how you get this. So right now you might look at, okay, euro dollars up to 0.733. And that was, okay, part of, let's say, we'll call this the worst case scenario, up to about 0.75, and then we would project this down. So we're at 0.733, and QuantBox is saying, well, first of all, if the trend continues at the same rate, not only does it continue, but at the same rate. Okay, let me get this tool out of the way. Okay, great. Um, it'll go at that rate. Well, let's redo this. Let's actually try to get it close. Okay. If this continues at this rate, okay, then you have best case scenario, worst case scenario, worst being there's an up before the down, like it goes up, but you think down. And so that's just how we get there. So you might look at it like, hey, man, we're pretty close to one standard deviation above the negative mean. Might be an opportunity to sell. And that's how you want to read all this stuff. Okay. So just for fun, let's take a look at that. So 107.5 is basically what the QB was saying. Loading. Okay. And we've already come to a high around, yeah, pretty close. This is, remember, QuantBox said 107.45, right? Let me just double check this. 107.35, 107.45 is one standard deviation above a negative sloping mean. Okay, cool. You see? So I guess, it doesn't have to go up there. It's just saying that would be one standard deviation. So you could, for example, assume this for a while. The market opens up. We go into this range. And then it gets interesting if it then breaks back below, because here's where it would become negative, and you would be back into the quantitative trend by selling one standard deviation above the mean with a negative slope, aka sell it high. Cool. Now, do we know that's going to happen? No, we don't know anything about that. But we're combining the quantitative analysis of economic data to create a bias, and then we're adding the slope and direction of the technical trend. Cool. Go a little further out, and you can see this is where we are. Now, let's say that doesn't work. This gets very interesting. Okay. This gets very interesting because we are forming a bottom. So the way you trade it technically is you assume you're going to stay in this range forever. So down, 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 up, sell, 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 down, 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 up. Whoa, 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 whoa. Down, 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 right? Okay, so we're ranging. Is there a potential for up? Oh, for sure, but it hasn't happened yet. So if you were buying it simply, I don't know, you're either short term or you're guessing. You're anticipating the break to the upside, which is okay, but just it hasn't happened yet. But if we do something like this between this week and next week, then that technical trend will be positive, right? Because you're calculating the rise over the run. Remember, M equals rise over run. This is how you remember it. M is the slope. And so your slope would go from, negative, neutral to positive. And that means at least at some point in the near future, or, currently, we'll say, you'll have a technical uptrend in a quantitative downtrend. So you could be a bull, just be careful because it's probably going to be a fragile trend. Okay? So that's all. So if you wanted to be a bear still, you have permission, as I said, somewhere around here, you can engage to the downside, and the conservative target would just be the previous support. Okay? You could go there or you can go there. Okay? All of that is based on price action. Cool. Let's take a look at S&P 500. Okay, that's a leading indicator for this time of day. And check this out. We've known for quite some time that 4,300. Okay, that was locked in stone on the first day of the month, which was right here. Locked in stone, carved in stone. That the conservative projected high for the month of June would be 4,300. Okay, nice. Good to know. Good to know. Then we get up here, profit taking. Then we get up here, profit taking. Okay, now we have it trapped. Now, first of all, does it seem like institutional investors are using the same tools? That they also knew that that was a top? Then good, you're using the right tools. Since we knew that, actually, probably we had a pretty reasonable idea of that number a couple of weeks ago. We knew it weeks in advance, but certainly by the 1st of June, that was carved in stone. So great. So what's next? Well, it depends if you're a bull or a bear. Okay. If you're a bull, you're buying at the bottom of the range and you expect to be going to, above 4,300. I can tell you where the next challenge is, but that's how you need to be thinking. If you believe we're going above 4,300 and you can give me a couple of reasons why, you're like, yeah, the Fed's going to pause. Oh, sweet. How did you get to that conclusion? Oh, I looked at this, that, the other thing. I'm like, right on, man. Good for you. Nobody knows if it's true, but at least you're not guessing. Okay, great. And the second opportunity for a bull is going to look like that. But the thing is, you buy, I wouldn't add, like, for example, you probably should have had that opinion quite some time ago. And you would have bought, let's say, this dip, let's say, and you're still in that trade. Or you didn't buy that dip Okay. You bought the second touch and you're like, I'm going to buy somewhere in here. Let's say you buy that. Okay, cool. You're still there, right? That would be your entry and you'd sit on that. And your stop would be just below that. Your second opportunity is if you're right, it breaks, it pulls back, and that's your second entry. Either way, you're buying dips at support. That's the only thing a bull should be doing. Okay. Now, in my book I wrote many years ago, I say the way that the market reverses is like an old man easing into a hot bath. It's slow. It takes a while for everybody to figure out what's going on. Okay. So this, and if you're thinking reversal, this up and then this down is the first profit taking of bulls. Now, the bulls that didn't take profit are regretting it in here. Okay. Then it gets to a double top. All the rest of the bulls, right? Just think of a MACD here is probably diverging, or stochastics is probably diverging because it's not a downtrend at this point. But if there's a lot less bulls, you get an oscillator that looks like sort of like this. Okay. You get that divergence. Okay. So, anyways, going back, let me get that color back and let me get my arrow back. Um, a bear is going to look at this and is going to look for a lower high, lower low. Okay. If it were me, I wouldn't look for it in the middle of the range. Okay. I would do it like this. I would assume it, but I'd wait for the breach. Okay. And this, it ends up being about the same price you're selling, but with a lot less risk. Now, you might not be trading the S&P 500. That's fine. But the thing is, if that happens over the next day or two, you have to understand the context of where it's happening in the price time continuum at an expected price of reversal. So if the market expects the S&P 500 to reverse and it does reverse, I think it's pretty significant. It could reverse for quite some time. This is not a random walk. Okay. There's a lot of logic in these markets. Like, for example, this pivot predicts this price. Oh, well, that's not perfect, Wayne. Okay. 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 Cool. Well, this, okay, predicted that. Well, that was perfect. No joke. This right here predicts this price in the last minute of the last hour of the week. We hit the exact target, right? There's a lot of logic going on, and this zone here, this move here, actually predicts a little higher. It actually says it can go higher to 43. I can't even see the number 4340.2. So that's your next thing that you'd have to look at. What if it did one of these? How would you feel? Okay. So as a bear, I'd have it marked plan A, sell if it breaches. Okay. So it's a trap and break strategy. Plan B is up here, where I think if it did that, let's say, okay, this is our destiny. I think not only is it going to try to hit that 4340, I think it's going to breach, go to 4350, hit the weekly target, drop back into the monthly, and then reverse. So that would be plan B. Okay. I call that an Arctic turtle. Market stretches even higher and then gets chopped, snap back. Cool. So again, if the stock market falls, dollar's probably strong. You already got that euro dollar. Let's look at the yens. Okay. Uh, well, let's take a look. I'll zoom in a little closer. Looks like I got a pissy little trade here. Can you see what I'm doing? Up, 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 down, down, buy. Up, down, down, buy. Okay. So not the world's greatest entry. I don't know why I put it there and not here. Maybe a gaff. Maybe I gaffed it. Okay. I should have had it on the central. I guess for whatever reason, I thought it was going to go up faster. So um, nonetheless, you can see, let me change the color on this. Couple of things that I want to point out that we call that a roll reversal. Then if you look at the daily pivots, that's a daily pivot entry. If you're looking at yesterday's moving average, it would have been around here at that time. So I probably should have had my entry at 104.50 for whatever. Dude, I don't remember. I don't know why I have it at 40 10 is it 104 104.70. I don't know why I did that. That's not usually a buying price for me. I'm a big fan of like psych levels. Okay, I like 50s, X 0.50. And then there's this idea around the OOs. So you have an OO here, a below, and then you have an OO above, right? These are big psych levels. And then above those, you have to think about where the stops are. So usually, right, the stops are just above 0020, okay, or 0080, no, right? And then all of a sudden, whoa, what's going on here? XX 0.20. And then below that is XX80. Okay. You're like, whoa, what is all that? Well, you have to remember at all times, something like 70% of all stops are within 30 pips of the current price. So if, like, for example, price comes up, gets above 00, okay, let's say 0010, there's a little bit of a pullback, somebody buys it, right? And a retracement back to 00, where do you put your stop? Well, if we're at XX10, the stop is going to be just below XX80 because you're going to be 25 or 30 pips away. That's where most, in particular retail, but a lot of stops will go just below 80. So, if it collapses, what happens when you get below 80? You hit a bunch of stops and the market drops all the way down to 50, right? And then it supports there. But if it if it holds, let me remove that. I don't mean to go into such a technical lecture, but anyways, if it does hold and goes up and breaches 20, guess what? All the bearish stops gets hit and it pops to 50. And it's all about stops. Okay? It's all about stops. Stops are what move the market. Exits. So anyways, what I'm trying to get at is I'm long at 104.70. That doesn't smell like me. 70? What who the hell cares about 70? Right? There's no stops around there, right? Like, what am I doing? I don't know. I wasn't drinking last night. I should have had a stop around 50. That would be much more logical. Okay. So I don't know why I did that. Just bad trade. So I got to stop below the moving average on the hour. I have a stop below the daily pivot and the midpoint psych level. Um, and the funny thing is, my stop is where my entry should be. And that's the funny thing about mediocre trades. Almost always, once you drop a stop on a mediocre trade, you realize your stop is exactly where a better trader would have entered, right? If you weren't such a mediocre trader, that's where you'd be buying. And you're like, dang it, I'm selling there, right? And then you get into this really bad problem where you're like, well, I guess I'll just move my stop way down here, right? Well, you made a poor decision to begin with, and now you just compounded your mediocrity into actually bad decisions. So, anyways, I got to live with that. Based on that 4 hour, it tells me this is going to drop all the way down to the 4 hour 21, knock me out for a loss, and then rally up. And that's what happens when you're mediocre. Okay. So this is just me. I guess I'm trying to be a good coach to show you what a mediocre trader looks like. Okay. So you're welcome. Okay. That's how to not do it right. All right. Cool. Other things going on here. I'm concerned about the Aussie dollar. At FX boot camp yesterday, I talked about this where I think it probably will go up. And I switched all these, right? We have these are bullish entries. And so we knew that yesterday. I'm like, yeah, it'll probably go up, but these are bad pips because this gray area is presumed exit. So we believe technically somewhere in here, the market will reverse. So now if you're buying it up here, you're ignoring the fact that bulls are supposed to be exiting and you're entering. So I said you'd probably make money if you did it, but they're bad pips. They're risky pips. You're adding risk when your probability of the positive outcome is diminishing. So they're high risk, low reward pips. They're not good. You have to disassociate with making money as a good trade and losing money as a bad trade. You can lose money and still have a good trade. You can make money and still a bad trade. So if you bought this dip yesterday, I would argue that it's not the best decision. Okay, there's too much risk. So, anyways, that is a concern. Okay, and then you look at this same trade. Let's drop this to a 4 hour, and it's the same type of trade but a lot of quite a bit less resistance. Let's put the same template on there. Okay. So if you were to compare apples to apples, okay, pound this is what the Australian dollar looks like, and pound is way down here and the Australian dollar is already over here. So obviously Aussie is stronger than pound. But if Aussie falls, okay. Now, if Aussie continues up, then it's going to drag this one up anyways. And well, you know what? Same trade, less risk. Now, you're not going to have the same good performance. Like, whatever, if Aussie yen continues to go up, even though it's in a profit taking zone, it's really hard to gauge what's going on there. And so this will still underperform, but at least you're not in that higher risk zone. So I would argue that this, if Aussie yen goes up 100 pips today, this one will probably only go up 70 pips because pound isn't as strong as Aussie. But I'm kind of almost looking at it like risk adjusted. I'd rather have the conservative 70 than the aggressive 100 pips, you know. Let's just quickly look at commodities and then we'll get out of here. Okay, there's the my WTI. Does it look like we might be on our way? Isn't technical analysis nice when you draw it out in advance? It's kind of like going somewhere and actually planning out the route first. Turn left on Highway 17. Okay. Yeah. So yeah, it seems to me like there's more and more of a probability that we are actually going somewhere with a destination in mind. Okay. weekly target, drop, and then up. Now that's a big ask because we haven't gotten through key levels of resistance, but I already have it plotted. If we do, okay, that's where you add to your position. Up, 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 down, down, buy, up, 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 down, down, buy. And remember, short-term traders, they just get caught up like crazy, right? Like they missed the fact that the finance minister of sorry, I do that every time. The energy minister of Saudi Arabia said they're going to push oil prices up. Short-term traders miss that. Oh, really? I guess that's relevant information. And then people have been asking, like, why is oil down if the finance minister pushed it up? Well, remember that gap? This gap, the market opened up with this gap. That was the announcement of the production cuts, which we already anticipated beforehand. Great. So it comes down, and everyone's like, why is it coming down? Well, retail traders are now just buying way after the fact. Okay. So we fill the gap, and then the next part is continue mission. Okay. And if we continue mission, we have to break resistance, which is here. Okay. And then we're going to buy a dip at a roll reversal. And so there's the next 2 weeks for oil. And the projected price is $78.60. Okay. Cool. And I believe, wasn't this the trade where we talked about at FX Boot Camp, not at QuantBox, at FX Boot Camp? We discussed a short in here, and we were right sort of in this area. I know it's hard to see. And I said, well, I think this is going to go up, in particular near support, and we're pretty close to it. If you were going to sell it, you have to sell it high, which is here. You can see it actually did it. Then it dropped, and then it reversed. So I think actually the finance minister, the energy minister of Saudi Arabia said it in here. It dropped closer to support, and this you have to go back. There's definitely support here, and then it up, and reversed, and up, and that should be right as rain. I'll show Bitcoin, and then let's get out of here. Okay, noise. Okay, this is set up for bullishness. Okay, in a bearish market. The projected low for the month of May was this price right here, 26,000 ish. Okay, 26,100. So if it's going to turn bullish, it's going to do one of these things probably. Okay, if it's bullish. Again, here's the mean price. Okay, this is the negative rise over the run. Okay, so this is the rise. In this case, it's a negative rise, which is the drop. From here to here is the run. So you can say, how far does it drop over time? Okay, so M is equal to the negative slope over, okay, the run, rise, sorry. Okay. And so the question is, will we breach that trend? So this technical tool is the same thing that QuantBox is doing with its technical trends. So it's looking at variance, 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 variance from the mean. Okay, so you get your variance, how far up, how far down. Okay, and then you square root that to standardize that variance, which is standard deviation. Cool. Now, there's two ways of looking at this. If you're a trend trader, you're thinking down. Why? Because you have a negative slope to the mean. On average, this is falling. So when it's high, okay, you trade it back to the mean. Okay. So a bear is going to look for this over the next couple of days. Okay. Mean reversion. If you've never understood what that means, you're taking the standardized variance when you're as far as it normally goes away from the mean. You want it to revert, go back to the mean. And that's why we use this. Okay. And then, of course, does it matter if we break that? Technically, it does matter. Has it done it yet? No. Should you anticipate it? I don't know if you should. Okay. It's more like if it breaches, okay, then it something is non-standardized. Something is probably changed in sentiment or fundamentals. So whatever made this happen, whatever was in the lexicon in that moment, something has now changed. Okay. And you might have to change your strategy or at least observe that something has changed. Maybe something's broken. Maybe the fundamentals have changed. Maybe something else has happened, but we have a non-standard deviation. And that would be something that should be observed. So that is for the day. What is today? June 8th? Is that, or is it still the 7th? I don't know what date it is. Do I have a phone? I have a phone. It is the 8th. So that's it for Thursday, June 8th, 2023. QuantBox Live. Good luck. Peace on earth. May the pips be with you. May your profits be above average. Have a wonderful trading day.